Hi everyone, my name is Tim Raes. I'm the Managing Director of Aussie Expat Home Loans, and I want to thank you again for joining us for our monthly Property Pulse, where you get to stay up to date with the latest trends and stats from Australian property with the best in the business. My guest for this month is Richie Ragel, one of the co-founders of Milk Chocolate Property. Milk Chocolate help expats plan, buy, build and manage their Australian property. Their property team is composed of some of the sharpest professionals across economics, data science, real estate, construction, property management, and customer service. And I've worked with them for many, many years, and they've helped many of our clients with their property goals. Richie, I really want to thank you for joining me today. It's a real pleasure to have you.
Thanks for having me, mate. It's a pleasure to be here and looking forward to the conversation.
Definitely. I thought it'd be good before we start off, just to hear a bit more about Milk Chocolate and why you and Michael started the business.
Yeah, absolutely. I suppose the primary reason why we started the business was Michael and I were actually we're best friends from high school. We ended up working together in advertising and marketing, but at that particular point in time, we also realized that we had a shared passion for real estate and construction. So as you do, the traditional side hustle, we started buying and renovating and selling homes for about 10 years before we decided to commercialize the business at that particular point in time. So I suppose the reason why we actually commercialized it was we have a really strong belief that the Australian property industry and the market deserves a bit of a shake-up. There's a few pain points, sort of a bit archaic and a little bit fractured, and we're just looking to solve those problems through traditional pillars of real estate, but also matching that with economics, digital design, machine learning, and really looking to revolutionise the Australian property industry through data-driven insights. And so how it all started out was that we decided to build a proof of concept on the Aussie expat market. It was a market that was unrepresented and lacked quality advice and a rigid on-the-ground service. Both Michael and I also were expats living and working abroad, myself in the UK and Michael in North America, respectively, and wanted to just be smart when we're overseas, looking to invest into the Australian property market. But ourselves found it quite difficult as well at that particular point in time. So we knew there was pain points that needed to be solved for this particular market. And so when we actually commercialized the business, we obviously started with this particular industry, with this particular segment of the market. We know there's about 1 million Aussies living overseas. And that's on rotation about 300,000 each year pre-pandemic. And we knew if we could solve those problems facing the Australian expats, then it's going to be a really great solution for all Australians looking to get onto the property market. So we set out to take the hassle out of planning, buying, building, renovating, manage property in Australia. And so as a business, we handle, as you touched on, everything, including single investments, diverse property portfolios, family home purchases, and managing that all the way through if there's any renovations required, and then ongoing property and portfolio management. So we're really excited about the journey that we've been on, and also what we can be doing in the future as well. So been working with you for a little while, which has been exciting, and hopefully your clients have got real value out of what we do, but that's essentially why we started the business.
No, definitely. We've had a lot of clients that have worked with both of us, and they've always said really positive things about you.
Yeah.
Disclosure, you've also bought 2 properties for me as well. So
yes, thank you.
Thankfully, they have done very well so far. So I'm very lucky.
That's good.
But no, I think any expat that's tried to buy property or has bought property from overseas or wants to buy property will soon realize that it's not an easy thing to do. I mean, first thing is agents will never call you back when you're offshore. And second is just trying to get research data, find properties, look for off-market listings, crunch all the numbers, make sure it all makes sense. It's where you guys provide real value.
Absolutely. And it's also, we have a business set up primarily for this particular purpose, but it's, we still miss out on properties because we do a lot of due diligence. We want to get our clients in the right position to be purchasing those properties. And I think we're going to talk about it a little bit later on in terms of what your buyers need to be doing to be able to be picking up properties in this particular marketplace at the moment.
Definitely. But before we get into that, it'd be good to just give an around the grounds. Each month we like to give an update of kind of what's happening with each major city in Australia. So I'll let you kind of take it from there.
Awesome. So I suppose just globally or nationally, home values last month rose 0.8% in May. So that's the 16th consecutive month of growth, which is obviously quite incredible coming off the back of COVID. And what we are seeing is those mid-sized capitals continuing to lead the pace of growth. So with Perth Adelaide and Brisbane rising by about 2%, 1.8 and 1.4% respectively. So the remaining capital cities recorded milder growth, ranging from 0.6% in Sydney, and Melbourne a slight increase of 0.1%. So across the board, excluding Hobart and Darwin, we are still seeing growth in all capital cities at this particular point in time. And what we are seeing on the ground, and also from the data perspective, is that it's based on extremely low levels of availability of supply across those markets. And that really is the best way to look at it. And when we're also looking at affordability and lack of affordability or sort of decreased serviceability on loans and what people can afford to buy, they're naturally focusing on those markets that are more affordable, which in that particular instance is Perth, Brisbane and Adelaide. And so what we're also seeing is the lack of stock, which is also driving up growth. So when you've got that perfect storm of low stock levels but high demand, we're naturally going to see that strong growth. And as an example, Perth and Adelaide stock levels are down 23% and 8% respectively from the same time last year. But while Sydney, Melbourne and Canberra are up 21, 27 and 35% respectively. So naturally, you're going to be seeing more opportunities in Sydney, Melbourne and Canberra, and also might just see a little bit more of a cooling in the market, which is obviously what we can see from the last month's growth trends. But also national new listings, less than 30 days, recorded a 12.4% rise in May. So providing more opportunities for buyers across the board. So it's always constantly moving, but we always like to look at that, in a comparison to 12 months ago to see where that market is heading and what those trend lines look like. I suppose more importantly as well, there's been a bit of a change in the guard. So Brisbane's housing market has posted solid capital gains basically since that COVID period, is now the second most expensive capital city after Sydney. So it overtook Canberra. So it's moved into second place, and Melbourne is now sitting in fourth place. Sydney housing market, it's reached a new milestone. So recording nominal recovery returns and setting a new benchmark that was set back in January 2022. So we're now back on par with where the market was at that particular point in time. Which is quite amazing given the sharp rate rises that we've seen. The real estate market in Australia continues to be buoyant over that period of time, and it just shows you the power and sort of the resilience of the Australian property market across the board, irrespective of those rate rises. And that's coming off the back of a lot of people having more savings in their accounts on the back of COVID, wages increasing slightly as well. So a lot of things are sort of playing into the market at this particular point in time. But also when you look at a capital city perspective, it's also really important to look at the quartiles in each of those capital cities. And so what we're seeing from a data perspective is the upper quartile home values across most capital cities have shown the lowest rate of annual growth, demonstrating stronger conditions across the more affordable price points of the market. So across the combined capitals, upper quartile dwelling values were up 6.7% over the past 12 months, compared to 13.4% gain on the lower quartile of the market. So as I sort of touched on previously, naturally, affordability, buyers are looking for areas that they can afford to purchase based on reduced borrowing capacity. We're naturally seeing them move into those markets at the lower quartiles, looking for stronger gains at the lower end. Rents are also up 0.7% nationally in May, and that's in line with an easing trend though over the past few months and the lowest monthly change since December 2023. So we are now starting to see that ease, which is probably good signs for those renters out there who have gone through a bit of pain over the last 24 months. Vacancy rates also nationally have also eased, only by 0.1% last month. But that is across all capital cities except for Darwin, which is tightened by 0.4%. So couple of signs there, which have been interesting to monitor over the last couple of months. I suppose it's something that you may get asked a lot. We always get asked a lot around distressed property listings. Over the last month, we've seen that decrease by 2.5%. So I know sort of leading up until the peak of the rate rises last year, a lot of our clients and potential clients were wanting to get an understanding or wanting to wait until the market peaked from a rate rise perspective, expecting a higher than average default on homes. However, we didn't see that, and nothing from a data perspective is pointing to that also. So it's good that Australian homeowners have been resilient and have been able to withstand and hold based on those rate rises. And that's a good sign. It means we're not going to see the bottom of the market fall out anytime soon, which is really, really important. So I suppose, mate, that's just a bit of an around the grounds across all of those particular markets, which is interesting to see. Key growth areas is Perth, Adelaide and Brisbane. They continue to be strong markets based on affordability, the types of housing, etc. Sydney is still being quite resilient, different pockets of Sydney as well. And most importantly, it's really important to talk about Melbourne as well. So Melbourne post-COVID has really struggled from a housing perspective. They had an extended period of lockdowns that had caused pressure on that particular market. We saw a lot of people from Victoria moving out of that state, generally moving up to southeast Queensland. Also, there was a lot of money spent through those lockdowns, and the Victorian government has enforced about 16 years of property taxes. And we're now seeing investors, again, being very cautious in and around this, but also moving out of the market and selling stock down and looking at other markets, because obviously with serviceability, high interest rates, cash flow is really important, and the additional taxes are only going to affect that further. So we believe that Melbourne is going to be a market to be watching. This may only just probably stifle it for another 12 to 18 months, but it's definitely going to be a market in the medium term that will probably start to see a sharper increase once everything starts to settle, given it's also now the fourth on the list in terms of median price points. It's a global city. Adelaide is quickly catching Melbourne. I think most of us will believe that Melbourne is a bigger city and can withstand high volumes and high growth rates. So I think that's going to turn once we start to see that economy start to level out a bit.
I think like there's a lot of speculation about Melbourne being a bit of a sleeper city at the moment, because like, yes, there's been a lot of new taxes imposed, investors, a bit cautious in Melbourne. The biggest thing is obviously the land tax change that they made there, where they reduced the minimum to $50,000 as a valuation before they start charging, which is much lower than any other state in the country. And obviously new stamp duties in Victoria are the highest in the country as well. But it does reach an inflection point, because I think, Melbourne still has the highest migration rate in Australia. Actually, more new migrants arrive in Melbourne than they do in Sydney still. Granted, I think a lot of them would be students, which is probably why the market there has stayed flat, but the rental market there is still extremely tight. But it's still an international city. It still has a lot of head offices for large companies. It does, any investor, the growth in Brisbane and Perth, especially in Adelaide, is before I think Melbourne has to start catching up again. And Melbourne is a very multifaceted city too. I think that's the biggest strength it has, is there's so many different pockets in that city that are worth a lot of money, and then some of them that are still really up and coming as well. So there is actually still a lot of places that you can probably find some value too.
Absolutely. And there's also not one economic driver for Melbourne as well, and Victoria. So multiple industries driving growth there. It's always been one of Australia's strongest performing cities from a residential real estate perspective, but also from an economic output. And it's really a moment in time at this particular time. And if you can still be purchasing an established freestanding home within a 10 to 15K radius of the CBD for under $1 million, that's going to be good value in anyone's eyes. And it's historically what we're seeing over the last 10 to 15 years. Hobart, went on a strong growth period. There was no real major sort of economic drivers to suggest that other than affordability. We saw them buyers look at Perth, Adelaide and Brisbane. Again, they see affordability. Those markets were basically at the bottom of the ladder in terms of median price points. They're now increased in value. And naturally, as Melbourne drops down, as we just touched on, I think buyers are going to start to see value in Melbourne at some point in time soon.
Definitely, but anyone I talk to at the moment, especially our clients that are buying for investment, it's all about Brisbane, which is It's, as someone who came from Brisbane, it's been an interesting observation to see how things have gone the last 3 years. Because again, I think it was actually a sleeper city before. It always had really great infrastructure. It was a really easy, friendly place to live. It's got really good beaches and amenities. And if you like the outdoor lifestyle, it's a no-brainer. I always thought it was really going to benefit from demographic shift as well, because it's just as more and more people start to retire, especially in Sydney and in Melbourne, and they want to be in somewhere warmer. I always thought Brisbane and the Gold Coast and Sunshine Coast was always going to benefit from that. And so far, it really seems like the numbers are pointing that way as well.
Oh, absolutely.
But I think, again, it's going to reach an inflection point where, places in Brisbane that I never thought would be worth $1 million are worth over $1 million now. And it's not the cheap city that it used to be. And also it's just so hard to make. It sounds like it'd be interesting to hear what you're seeing from clients that you're working with up there in terms of trying to make offers. But from our perspective, even so, ANZ, I think I told you earlier, ANZ came out today and said there's a special priority queue for Queensland and Brisbane applications now, because Brisbane always used to be our safest market. It was always, okay, you can do a 2-3 week finance clause, 30, 60, 90-day settlement. It was very easy. Now everything has to be unconditional. We want to settle in 30 days. It has to be, you have to move quick. It's like 5-10% deposits. So it's really shifted very, very quickly. And I think it means, it'd be interesting to hear from you what you're doing with your buyers up there in terms of how you approach offers for properties in Brisbane.
That's a good point you made around Brisbane. Like back in the day, where we used to also have a due diligence clause to only ever use in Brisbane, and that was basically a free throw at the stumps. Essentially, 10-day DD clause, which allowed you to do all of your DD, and you could retract or rescind the deal without any recourse. It does still fly in some instances, but in general, that doesn't fly anymore in that particular marketplace. So, and what we're telling our buyers and anyone who's not using a buyer's agent as well is one, obviously just have your pre-approval in place. You just need to have your finances ready to go. Obviously, an unconditional offer is going to be the most favourable way to be purchasing a property. However, if you're going to be making an unconditional offer, make sure you've spoken with your broker or your bank. You've completed all the relevant due diligence, reviewed all the pre-purchase reports, and I can't stress how much you need to get pre-purchase reports. We do stipulate building and pest, plumbing, and electrical reports. And obviously, you've read the contract to sale and you fully understand and ensure you've reviewed that in detail before you're making an unconditional offer on the property. If you don't have the time to do that, do your desktop due diligence, tick all the boxes, dot all the I's, cross all the T's, make sure you've done a lot of the heavy lifting before you are actually viewing the home. So ideally, when you've viewed the home, if it still stacks up, you've checked the reports, etc., you can almost essentially make an offer there and then on the spot, or at least in the next 24 hours. In the really hot markets, they're generally giving you a time frame of when you need to get your offers best offer in by a certain date period, best and final. So in those hot markets, so you do know you've only really got a couple of days to do your desktop research, get your reports done, view the home, and then get your offer in. Don't try and undercook the price point. It's not a market when it's hot, especially in Brisbane, Perth, and Adelaide, for instance. If it's advertised for 800 and you've done your comparable sales and you think it's worth 800, don't go and offer 750. You will just continue to miss out, and that market is going to get away from you. Be prepared to pay what the property is worth, potentially a little bit more to secure the home now, because you are, if it's an investment property, ideally you're going to be holding it for at least 10 years, 10, 15, 20 years. So we do have to pay a little bit more upfront. That's not the worst thing in the world, because in these types of markets, it is quite difficult to secure an asset, and it could take you another 2, 3, 4 months to find that right property. And before you know it, that market has moved past where you're prepared to purchase that last property for. So that's the key things that we're looking out for. Obviously, do your work. If you're not using a buyer's agent, do your best to source and uncover pre-market and off-market opportunities. That's where we're seeing great value at the moment, is trying to get into the market before everyone else does. Gives us time to get a jump, get an offer in prior to hitting the market or first inspections. We can be really strong in our offer, giving ourselves more time to get ourselves to a closer position to be unconditional. And that's what everything really needs to ladder up into, is getting yourself to an unconditional position as quickly as possible, because vendors know that they're selling in a competitive market. And if you come with an offer that's full of conditions, they know there is an unconditional offer just around the corner. So don't try and trick the vendor, or don't try and pull the wool over the eyes. It just doesn't work in this particular marketplace. So that's essentially what we're seeing, and that's what you really do need to do to be competitive in this market. And if you can't do that, you don't have time, you can engage Milk Chocolate, and we can obviously do that for you. We do this day in, day out. Now, as I said, we still miss out on properties too, and that's how hard it is. Like, it's our full-time jobs. We have a team in place, have boots on the ground. As a team, collectively, we've purchased and transacted over 1,000 properties in our total experience. We still miss out on properties. That's because, though, we are really diligent in the way that we assess and apply a criteria assessment of a home, and we're happy to miss out on properties if they're not ticking all the relevant boxes. So be careful not to fall in the trap of FOMO as well. And I know that can be quite hard if you're frustrated and you've been doing it for a little while and your pre-approval's running out, etc. FOMO can be a detriment to your investment strategy and criteria if you end up purchasing property without ticking the boxes I've just mentioned, such as your pre-purchase reports, your due diligence, etc., doing those contract reviews. If you're not doing that and you're skimping on that just to buy a property, unfortunately, inevitably, what we see is that you're going to uncover some pretty hard truths thereafter, and it's going to cost thousands of dollars, not hundreds of dollars, and that's a lot of money, and sometimes people can't afford that. So, It is, be prepared to miss out on properties, and get the right one under the right conditions.
I think, especially buying as an investor, it's very important to set certain parameters, because at the end of the day, if it's an investment, it's not something you're going to live in. It has to work from a numbers perspective. So you can't afford to get emotional on those purchases, and don't be afraid to walk away if the numbers don't match up with what you're expecting from it. So
absolutely, what we say as well is really just understand your personal economics and ensure your offer reflects what you can afford. So don't fall in the trap, as you say, getting emotional and paying overs for that and stretching 10, 15, $20,000, because you might need that 10, 15, $20,000 down the track for anything that comes up from a maintenance perspective as well. So
Yes,
just be ruthless. It's easier said than done, but you just got to bide the time. There will be a property that comes up for you. You just got to get yourself in the right position, but
definitely.
don't sort of try and fool the market. Don't try and bluff your way through it. Just prepare to be offered to fair market value to secure the right asset.
Been doing this a long time. I've been lending money for like 18, 19 years now. And one thing I've learned is it will happen when it's meant to. So don't get too defeated if it doesn't. Trust me. Everyone, I have clients I work with that take 6, 9, 12 months, 2 years sometimes to buy a property. But when they eventually get it, they're like, okay, this was meant to be the one. So just have to persevere a little bit sometimes too.
Yeah. So just while it's fresh in my mind, we do have a current sort of opportunity that we're looking at that we found for a client off market, got them into a position to make an offer. They were hesitant in moving forward on this purchase. They have been sort of with us for about 4 or 5 years, haven't been able to pull the trigger because of, in their mind, what they saw as issues. And in this particular instance, it was 1 bedroom that didn't have a built-in wardrobe, and they delayed in signing our purchase advice to allow us to go off and make the offer on their behalf. Because of the 2-day delay that they made, the agent decided to take that to market, and now they've got the first open tomorrow, and we believe there's about 15 groups already registered for that particular inspection. And now we're going to be competing with 15 other buyers for a really great asset because of a delay, because of a built-in wardrobe that wasn't in one of the bedrooms. We know you can go to IKEA, you can put a built-in wardrobe probably for $500. And that's, that potentially going to cost them a great asset that is ultimately going to return that in spades over the long term. So
I think, not every property is ticking every single box every single time. Right? It's always a bit of a balance between what are the really core things that are important and what are the little fixer-upper things that can be done actually pretty easily after settlement.
Yeah, and also like you're going to be buying in markets that potentially you don't know of. You've never been there yourself. If it's from an investment property perspective, it's not in your own backyard. So don't apply the thinking that you would apply in an area that you're living to an area where you're purchasing an investment property, because everyone is different in terms of how they would like to live in a property. So don't, just because you think there's not a built-in wardrobe in this particular asset, doesn't mean someone in that area has the same sort of care factor about that. So it's really important just to be completely unemotional about the investment property purchase.
I just wanted to spend the last portion of the segment. We talked a lot about Brisbane, but the other really hot market at the moment is Perth. It's also probably every other second query I get is what's happening in Perth. We want to buy in Perth. Perth's a really strong market. I lived in Perth for 2 years before I moved to Singapore. So this was back in like 2013, 2015. I moved when it was at the height of the boom, and when I left, it was like a very sorry state. Like everything had gone down 40% and rents were really cheap. And it told me that it's a real boom and bust economy sometimes over there. But, so I've always been a bit wary of Perth as an investment, but it sounds like, it's had the strongest growth in the country for the last 12 months. Correct me if I'm wrong. It's like 21 or just under 21%.
Correct. Yeah, it is.
And the demographics of what's pushing that growth seems to be very different to previous Perth growth cycles, which were always based on resource prices and resource investment from the big miners over there. Correct. But I'd be keen to understand from your perspective, what's driving it this time and what makes it a more safer investment market for people that want to go in.
Yeah, it's such a relevant topic for this chat, and also as like you are, we're getting a lot of inquiry about Perth. And it's important to point out, like up until this particular point in time, Milk Chocolate has made a conscious decision not to be purchasing in Perth from an investment perspective. So we do purchase properties in Perth, and they're generally for lifestyle or family home opportunities only. However, we've resisted the urge to get into the Perth market up until this particular point in time. And primarily that has been focused on, as you touched on, it's been a market that has been driven by the mining and resource industry, and the correlation that we've seen historically between iron ore prices, the mining industry, and also into property prices. It's been pretty direct. And for us, that's always a concern when you're purchasing into a market that is driven by one economic driver, which I touched on with regards to Melbourne having multiple drivers. So, if that industry does slow down, then inevitably you see the residential real estate market cool on the back of that as well. So the reason why we've made a conscious decision to sit on the sidelines up until this point is really just to monitor this current growth phase and understand the data. So not sort of jump in and sort of be the sheep and follow what's the crowd are doing, and really just understand the data, understand the trends, see if there's any correlation. Do we believe this is now here to stay? Has Perth sort of finally overcome those historical sort of issues with regards to the correlation between mining prices and property prices? And what we're seeing at the moment is, from a growth perspective, as you touched on, it's extreme growth. It's the strongest market in Australia, has been for the last couple of years. But what we're seeing is historically low stock levels and unprecedented demand is driving growth, coupled with serviceability constraints, which I've touched on so far. So reduced borrowing capacities is driving primarily investors into this market, chasing stronger yields to cover their holding costs. So Perth is really attractive. You consider going back 24 months before this current cycle, property prices were less, in markets that we're looking at now currently, were less than $500,000. Yields about 5%. That's very attractive to buyers looking to get into the market where interest rates at 6%. And so that has been one of the major draw cards. The current boom since 2021 in Perth is driven by affordability, as I touched on. But also there's been a record infrastructure boom as well. So $39 billion in investments in infrastructure, which is what we look for over the next 4 years, which is including new and expanded hospitals, more schools, the transformational Metronet program. So if anyone doesn't know what that is, that's a construction of around 72 kilometres of new lines and adding 23 stations to the Perth suburban network, which is obviously really key from an investment point of view. You want to see that connectivity in the marketplace and in different sections of the city, and then also just major investments in roads and decarbonising our electricity grid. So a couple of key things for us that are really promising from that perspective. It means Perth is now moving to a point where it's going to be less reliant on the mining industry. From a livability perspective, the prestigious Economist magazine has it in the top 20 most livable cities in the world. So you said you live there. I mean, you might be able to vouch for that as well, but it's obviously on the coast, beautiful beaches.
Oh, the beaches are some of the best in Australia. And yeah, I think if you have a young family, it's a really good place to raise children, and the schools are really great there too. So
yeah, absolutely.
Very safe.
And the percentage of minerals production in the state economy still remains high, but the prices of key minerals and commodities are stable over the past few years. So this is different to what we saw leading up into that 2008 global financial crisis, which led to a really significant bust at that particular point in time. And also what we had seen historically from 2014 to 2020, Perth's net interstate migration numbers are in the negative. So more people are leaving the state than coming in. And that was driven by what we saw in that mining industry and iron ore prices. But since 2021, this has returned to the positive. It's had a really steady incline and it looks really stable at this particular point in time. The additional sort of economies and infrastructure spend is positive to see, because that's going to provide continued work and employment and create a more attractive state for people to come to, which is really, really interesting. And when we look at the size of Perth, it is the fourth largest city and economy in Australia. So it's got 2.3 million people, 2.6% growth in 2023 and 1.5% the past 5 years. So that is a really solid indication of economic dynamism and as a destination for investment and lifestyle. And there's a low unemployment rate of 3.4%. And, that's really, really important for us to understand. Is there enough work to keep the growing population employed? And that is the case at this particular point in time. So that's really, really promising.
Definitely. I mean, like I said, it seems like the boom there is really being driven by more fundamental growth factors than what it historically has been. So I haven't been as nervous this time when people have been buying there. But again, people love the lifestyle there too. Or everyone I know that's moved away from Perth always wants to move back to Perth too. It's always.
There's a bit of a sort of an east-west dynamic, isn't there? Like people from the east potentially may not sort of like
even some of the
West
expats we have in Asia,
West.
they always want to go back to Perth at the end of it. They just think it's a great place to be. So yeah.
And also it's a good point sort of just on its location and it's, where it is located in Australia and on the world. It is a better connected city generally to Southeast Asia, to the UAE, et cetera, and Europe. And so that's attractive as well from a lifestyle perspective, but also from an employment perspective. So it's significant in terms of what we're seeing from a growth perspective. So it's grown by about 62% since COVID. So from a dollar value, that's about $280,000 on the top of the median price that it was at the onset of COVID. And also regional WA, the same, 61.9%. It's had the strongest growth nationally, slightly ahead of Adelaide and Brisbane over that same period of time. So Adelaide was 61%, Brisbane about 60%. As you touched on, it's been about 21.9% the last 12 months growth. Last 3 months, 6.1, and the last month, 2%. So still really strong. And it's continuing to show those strong growth patterns. We are, as a business now, for the last couple of months, we've been working on our due diligence, research, understanding the data, looking at the trends. We're on the ground, boots on the ground, looking at different markets, specific suburbs, the streets within those suburbs, and we're close to finalising the locations that we're going to be focusing on for some of our clients at a lower price point who are looking for affordable investment options that are presenting higher yields that's still going to provide long-term stability in their investment portfolio. So in the next couple of weeks, we'll be purchasing our first couple of properties in Perth, which is exciting.
Okay. Yeah.
But we wanted to wait until this particular point in time just to make sure that there is it's a stable economy, it's a stable market to be investing into.
No, definitely. I mean, you guys have always done, due diligence, and the figures and the numbers and the research for you has always been one of the strengths, and the data that you have as well. So
yeah, absolutely.
Yes, I'm sure it'll be considered.
Absolutely. Yeah.
Cool. So I guess we'll leave it there for today, Richie. But if anyone's interested in finding you, is that what's the easiest way to get in contact?
Yeah, you can go to our website, which is milkchoc.com.au, or you could reach out on LinkedIn and drop us a note, or
reach
say
out
good
to me.
day, or reach out to Tim, and he can put you in touch with us. Michael, my business partner, is the best person to talk with in this particular instance.
For sure. Cool. Thanks so much, Richie. I appreciate it.
Cool. Thank you, mate.